Okay, Doug, are you all ready?
I'm ready.
Okay, I'm pressing broadcast.
Welcome everyone to the ASAP webinar. This one is on financial management and compliance. I'm Debbie Khalil. I work at USAID in the Office of HIV/AIDS in Washington, DC, and I serve as the COR for the ASAP mechanism. Just a quick background on ASAP. It is our central mechanism in the Office of HIV/AIDS that is building capacity, very focused on support for local partners and local NGOs and government partners to strengthen organizational capacity as well as reporting with a focus on PEPFAR reporting capacity. So as part of the work that ASAP does, we have this webinar series, and this is, I think, our third of the series. And we have other topics that will run through the end of this year. So we're really excited to have a very engaged conversation with you all and to have a chance to share some of the best practices and learnings on financial management and compliance for local partner awards. And to make sure we also want to have interaction and hear questions from you all, there is a Q&A tab at the bottom of the screen. And so if you have any questions, please put them in there, and we will take breaks during the webinar to answer some of those questions as we go. Of course, we'll also have a chance to answer questions afterwards. And if there are questions that we weren't able to address, we will have a chance to follow up in writing after the webinar and share with all the participants. So I'm going to hand it over. We're thrilled to also have some colleagues from other parts of USAID Washington on the line. So I'm going to hand it over to Adrian Shade from our Office of Assistance and Acquisitions just to give a welcome.
Everyone, I'm really glad that you could join the webinar. We're really excited to be offering this. As Debbie said, I work in the Office of Acquisition and Assistance. I'm one of the ANA specialists who works specifically on PEPFAR. And I just want to let everyone know that in true OA fashion, we will be answering questions today, but some of them the answers may come later. We will be taking notes, everything is being recorded. So anything that we can't answer off the top of our heads and needs a little bit more research, we'll get back to you.
Thanks so much, Adrian. And I know we also have your colleague, Chris Nicola, on the line too. And if there are any other input he wants to give throughout the presentation, we'll have him join in as well. And we also wanted to just welcome our FO colleague, Walter Hammond, who has joined. And Walter, if you want to just say a quick welcome also, please.
Okay. Yes, my name is Walter Hammond. I'm representing the CFO's office and specifically the Office of Enterprise Risk Management. And so kind of our perspective on all of this is, or kind of the ERM perspective on all of this is that, that we help ensure the success of programs, that we help you achieve your objectives. To do this, it's a lot about knowing context, assessing opportunities, threats, risks, and seizing opportunities ultimately to ensure that you have the skills it takes to be administratively successful in the activities and programs that you're running. And this particular webinar is a great opportunity to build the administrative skills that you need to kind of ensure that you have the right resources at the right time to solve the right problems.
Great. Thank you so much, Walt. And we hope too that we have some colleagues from the field who also represent Office of Assistance and Acquisition and the Chief Financial Office or the Financial Management Office in the field. So throughout the webinar, if those folks also have input they'd like to share, we really welcome that perspective from field work and sharing and responding to some questions or asking questions as well. So with that, I'm going to turn it over to our project director for the ASAP mechanism, Catherine Brokenshire Scott.
It looks like Catherine has dropped off. I know she was using hotel
Okay.
Wi-Fi, so hopefully she will be back shortly.
Okay, so while she's reconnecting, I know she's calling in from DRC or Cote d'Ivoire, sorry. So while she's reconnecting, we will turn it over to Doug Frankie from Sustainability Solutions, who's gonna lead our webinar and take over, and he has slides he will share with his screen. Doug, are you there?
I am. Great. Yes. Let's go share screen and get you guys up. Can you hear me? Hello, can you hear me?
Yes, we can hear you.
Fantastic. Okay, welcome everyone. Thanks to the joining the third webinar. As our introducers have said, a lot of exciting things, and we hope that you will take something out of this. There is a lot of potential things to discuss here, but in terms of, these are high-level discussions, and as Deborah said, we're going to have to be stopping throughout for Q&A after each of the sections, and then at the end, certainly an overarching Q&A is available. Can you see the slide pack, hopefully? I'm sharing slides. Are they up?
Yes, they're up in presentation mode, so please go ahead.
Fantastic. Okay, well, again, thanks to ASAP and USAID for enabling the participants and especially the implementing partners to gain knowledge on how to manage their funds. As we've said in the earlier webinars, I mean, USAID gives you these funds to spend and to do good things, but it does come with the strings that certainly Walter and the other folks know very well need to be complied with. So this course is about financial management compliance, and there will be these type of topics that we'll be talking about, how to develop a budget at a high level, allowable costs. You know, some people don't realize what they can recover, and as we found in the Johannesburg session here, many folks were lamenting that they can't recover all their costs, and as we'll see, you probably can if you know how to ask. We'll briefly delve into direct, indirect budget items and what the differences are. We will explain how to calculate your modified total direct cost, MTDC, a very important concept, so that you can recover that next line item, the 10% de minimis. We'll briefly touch cost share because many organizations will get cost share or have cost share now, and how to, what you can include in cost share. And then we'll close with the monthly financial reporting and pipeline burn rates. And maybe, you know, Walter and any other CFO folks certainly can weigh in there. Okay, any questions? So we'll just jump into it. Okay, so developing the budget, I think it's quite important to, as certainly as Adrienne mentioned in a preview to this, to have as much detail as possible. I don't think you can go too short on having enough detail. Okay? The more you can explain why you need stuff and why you need money for which activities is going to be important, the better you'll be. So we talk about activity-based costing, and that, you know, the concept is you are going to be doing certain activities, you know, whether it's drugs or treatment or orphans or whatever, and each of those comes with a cost. And the more you can link your costs to your activities, the better you'll be. The next thing about breaking your activities into mini budgets, sometimes, depending on which country and what you're doing, your budget may be, you may be asked to split your award, possibly, and USAID and CDC in some countries are, you know, delving the country up into regions or parts or activities. And so, you know, what we ask you to do is when you create your budget, be able to break it apart as easy or as difficult as you're putting it together. But the whole point is, you know, you might get a message to say, look, you were going to do the whole country and now you're doing half. Please split your budget. So just, you know, be ready to break it apart. Okay, it's also very important now to be able to task your activities or manage them as part of your compliance requirements under performance measurement, especially important under PEPFAR, is being able to relate your activities to your costs. And this course is not about that, but that's something that might be covered in a future course. Okay, also having a budget, having these details, as we'll see later, is important for justifying you to claim your 10% de minimis. And we'll talk about these items. We need to go into your base, into the vehicle or let's just call it the base that you're going to be getting the 10% on top of. Okay, and then finally, again, by having the budget is going to enable you to recover all allowable costs, as we'll discuss below. Okay, so the definition of budget, and you see this does come from our CFR, Code of Federal Regulations. We've talked about this in the past. This is the uniform guidance. And if anyone doesn't, well, let's just take this note down. It's at www.ecfr.gov, Code of Federal Regulations. And in there, you'll want to go to the 2 CFR section, and but you'll find it if you just search for uniform guidance as well. But regardless, they have good definitions in there, and here is the one for budget. And so basically, it says, the items that you will be able to charge, and you can go there later to read more about it. Okay, so you will be proposing for, we talk about acquisition and assistance is where it's grants and cooperative agreements, and that's what you're going to have or get, versus acquisition is contracts, which we're not talking about today. And so the concept is you're going to get a request for an RFA or something, and it's called shredding in the industry, where what it means is someone's responsible for tearing apart, literally, the solicitation and sharing the parts in pieces with those who are going to be preparing them. So let's just keep it very simple. There'll be the technical section, which is the team that's saying we're doing this, working here, our people, our processes, our relationships, and then the finance section. Okay? And what you'll want to determine right up front is if the funding that's available is being defined. I can't say more often than not, but I think certainly from what we've seen in Southern Africa, more often than not, there isn't currently a stated amount. It's normally great. We're trying to have 10,000 people on treatment or something like that. More often, the target is defined. Okay, and it's very important then to read the description, understand what you're being asked to achieve, and you cannot be too careful at making sure you understand exactly what you're expected to achieve in terms of, again, targets of where. A geographical scope, again, certain regions, states, countrywide, and then anything specific about the personnel that they want you to have. Okay? And then certainly the solicitation will explain in the instructions, everything about the costs. Again, read your award, read the solicitation, and follow the instructions. It will tell you, use these forms, how many pages you can have, what font size, what type. It'll be 11 Times New Roman, for example. Or again, which currency are we proposing in? Are you proposing in dollars or the local currency? Exchange rates, are they telling you to use a certain rate at a certain time? All these things, if they're in there, you must follow those. Okay, so read the solicitation. Certainly, this is more about financial management and budgets. So as we'll see a little bit later, be as descriptive as possible of why you need these costs and what they're going to relate to. Okay. One of our earlier communications was about our earlier webinars was on the cost principles. I think that's still available for those who want to go back. But your cost principles, most of the people on this call, assuming you're a not-for-profit, are at the 2 CFR 200, which is a uniform guidance, part 400. And that is the cost principles that applies to everyone worldwide. It doesn't matter if you're U.S., non-U.S., if you're not for profit, those will be your cost principles, which is quite good. And again, there's your link right there to the ECFR we talked about. Okay, the cost application or the budget certainly will come in, which you should be able to create the summary budget. And that's what USAID certainly, what happens is you need to be aware, a lot of your financial management will relate to the line items that are in your award. Okay, and the summary budget will frequently, they may even give that to you, as a matter of fact, in the budget and the RFA, but it will be built up based on your type of line items. Let's assume USAID is going to tell you which line items to put things in. Then there'll be the detailed budget, which breaks down those summaries, and then the budget narrative, which, as Adrian has helped us to talk about earlier, or in the last preparation for this, to make sure that you have enough detail to describe what you're doing, What are you going to spend those USAID funds on? So let's just look at some examples. Here we have an example of, I'm just showing 2 years, so it can be big on the screen, and certainly your budget could be broken down differently, but in general, certainly you're going to have personnel costs, the salary costs for the staff doing the activities, and the fringe benefits that go along with that. Again, frequently there's travel. Again, this could depend on different awards, equipment, supplies. Again, contractual is always quite interesting, sub-awards, subcontracts. You might have a consortium, and different organizations are doing different things. You need to be quite clear about that. Just be aware of construction. We talked about this in a previous webinar, but if you're going to have construction and USAID is giving you money for that, there has to be a line item. Okay, so when you're doing your preparation, realize if you're going to be doing brick and mortar, knocking down walls, building stuff, you're going to have a line item for that. And then there'll be the ODCs, or other direct costs, which is pretty much a catch-all that we'll talk about here in a few more minutes. And that will lead to what we call the total direct costs. Okay, sort of between line items 8 and 9. And then I'm saying if you're lucky, but possibly you will get the 10% de minimis, which we've included in here, and I'll explain to you how you will be calculating this later, and then you'll get your total costs. Okay, we show here cost share just in a different line. We will be talking about cost share a little bit later, but it will be somewhere included in your award if you have it. I see someone has a hand up. We're going to get to that in a second. Okay, so that's a classic summary budget. That would probably be what your award looks like. Okay, then the detailed budget will describe all these sort of categories. Let's go back up. It was all these different items. You're going to have a much greater detail in the detailed budget. Okay, so again, make sure your descriptions, well, we'll put it this way. Each of these is going to have probably a sub spreadsheet with the detail on it. Okay, and again, unit costs, get as granular as possible. So here's an example of the personnel, or the key people who would be part of. Let's go back up to here. Here we have $200,000 for personnel for year 1. And so great. So in your proposal, and frequently they want you to certainly break out year 1 in detail, and 2. If it's a 5-year award, sometimes we can't necessarily break out in detail years 3, 4, 5. You might just have an inflation factor. But certainly for year 1 and 2, I would expect to see details of who our people are and their offices and what their rates are, etc. Okay, so here you'll see this 200,000 here agrees to our 200,000 there, and it would be the same for every other line item. Okay, and then the budget narrative describes what you need that money for. Okay, provide enough detail so the mission or Washington can understand how you're spending that money. So this is what we talked about, activity-based costing, and we'll give you a couple quick examples on the next slides. Okay, so just be extremely descriptive. So if you've got 1,000 orphans, you need 1,000 beds, you describe that. Great. In X county or X state, I'm going to have 1,000 orphans, I need 1,000 beds. One of our jobs is to provide bedding. Great. Here's the beds. That's why we need it. Okay, if there's any unique or excessively high cost, something that you're not sure about, you can always ask questions. Write down 2 CFR 200.407. That's about prior approvals, and USAID encourages you to reach out to them. This is also in the mandatory standard provision number 1, right up front. They say if you're not sure, ask. It's the right thing to do. Okay, so here we have descriptions of the personnel, and we say, great, there's 4 key personnel. And how much time are they spending on the project? And it would even be much greater than this, possibly who they are, the medical officer, she or he is an infectious disease doctor. Remember, at this point, you are still selling yourself and trying to win this way. Okay, so again, our key personnel, will be breaking those people down into various things, defining them, their positions, saying how active they're going to be. Are they 100% or part-time? Are they regular employees of your organization? Are they contractors? Are they partners? Are they possibly your partners, your consortium members, staff? You need to be fairly clear on those things as well. Okay, and then the non-essential, but the non-key personnel, and normally there might be up to 5 key personnel defined in your award, saying you need the chief of party, maybe the M&E person, grants manager. The U.S. government will define that for you make sure you fill those spots in very detailed. And then the rest of the people, again, you're going to be defining if they're non-key. Nationality is sometimes quite important, depending where we're working. You got to be careful there. And then it's going to be, a lot of it's going to be about, labor costs and how much you're charging for these folks. Of course, this is a budget we're talking. And so there's various ways to talk about labor costs. Each mission normally has what's called a local compensation plan, which you can ask for. It's not always granted easily, but in theory, you should be able to get that. And that defines how much the U.S. government pays their people. And conceptually, you shouldn't be paying your people more than they pay their people. But there could be reasons why you may need to pay more, or possibly, hopefully, pay less. Okay, but that would be a normal way to gauge your labor costs versus others, or versus versus quote unquote the market. Also, in many countries, they have what's called salary surveys. Certainly, I know the Big Four in certain countries conduct these for their clients. See if you can get them if they're available. Certainly, you may have to pay for it, but the bottom line is they're normally worth their weight, or maybe a couple NGOs would want to reach out and share them, as long as you're being fair to the provider. Okay, I'm going to have a question here in a minute. Okay, then we're going to have fringe benefits. Again, everyone does have possibly health and other sorts of activities, vacations, sick leave, all these things. Be as descriptive as possible. Here we have an example. Okay, if this person is severance pay, and frequently you have here, the example is 1 month of severance pay per year, then you define that. You be very descriptive, saying, great, part of we're including these costs, which we must incur. It's very important that you never, well, put it this way, you always follow the rule of the country you're working in and the U.S. government rule, if possible. And so U.S. government will never expect you to break a rule. So the whole point is, if you have to charge something, then you have to explain that to your agreement officer or the A&A specialist, saying, we have to incur this cost. It's maybe the labor laws have changed or something. Okay, so please follow both the local rules and the U.S. government rules. And then again, there's frequently specific guidance one more time, in the cost principles at 200.431. Very detailed descriptions of what's allowable. And again, but certainly for those who are on the previous webinars, the U.S. government is always willing to pick up their fair share. But they're not wild about picking up an unfair share. Walter, you want to weigh in here? I see you come up there. You're always welcome to join in. So yes, there's a lot of guidance in the cost principles, and certainly in the solicitation, there'll be guidance on this stuff for you as well. Yeah, just a couple more examples. Travel. Why do you need to travel? Is this for the key staff? Is it for our chief of party, or is it just the staff every day? Nurses, doctors, community care workers. You distinguish between the international travel and certainly versus domestic travel, and this will all be broken out in your award. You need to break all this stuff out, all these details out. Okay, and certainly if you're going to have international travel, the U.S. government's going to want to know it, because there's certain rules on that in the mandatory standard provisions on traveling. But certainly, who's going, how many days are going to be out of country, what are they doing, exactly why does this person need to be at that AIDS seminar in wherever it is this year, and that sort of stuff. So be very descriptive. Per diems, of course. Travel comes with costs, and it's very important that you have your own written policies and procedures about travel. What the guidance says is if you don't, you can certainly defer to the state.gov, that's where it is. But that's pretty much what the U.S. government uses for its employees. But generally, I would expect that certainly in-country NGOs who are, especially the new local partners, probably will have more frugal, or what we call prudent, rules on your local costs. So your costs, your local policies may not rise to the level of state.gov. Okay, and those guidance, again, travel is in your cost principles at 0.474, and in your mandatory standard provisions in the required as applicable section, but I'm sure most people will have travel at number 8. There's more guidance there. Okay, again, I'm not going to go through, I'll go through these, but we've shortened them from the earlier version. But equipment, Very clearly defined, U.S. government, any item over $5,000 will need to be particularly accounted for and put on your fixed asset register. Again, there's guidance for this sort of this category in both the provisions and which is going to be attached to your award at Section C and in the cost principles as well. Okay. So equipment, again, certain times you're going to need prior approval from the agreement officer. I'll show you on the next slide some specific ones, but motor vehicles, that's quite important. So there's certain costs U.S. government wants to be aware of. And in procurement, which is not covered under this webinar, but there's specific rules on procurement on buying certain things, okay, and where you buy them from and your geographic codes and stuff like that. Okay? But again, in the narrative, if you need a vehicle, why? Okay? Yes, we're going to be working up country, so we need a four-wheel drive vehicle, or it needs to carry, 13 passengers, 13 nurses, or whatever. Explain why you need the vehicle, what it's going to be used for, and certainly how it relates to the program. Okay, as we talk about the inventory lists, we'll have fixed asset registers of everything that everything over certainly $5,000, or a limit that you might set for yourself. Many NGOs use $500 to keep track of their own assets. So if you NGOs use 500 as your threshold for keeping track of assets, you must then keep track of the U.S. government assets at that same threshold. Okay, restricted commodities. These certain types of things require prior notice, written approval from the agreement officer. Be very careful. It's not your AOR. Prior written approval from the agreement officer to buy these certain things. Okay, so agricultural commodities. Most of you are PEPFAR partners, but certainly U.S. government has a Feed the Future program, which would be quite big in agricultural commodities, including seeds. Very important. GMO seeds are quite touchy, so just be careful there. Of course, motor vehicles. Many of you do or will buy motor vehicles. Pharmaceuticals. That's not the stuff, the aspirin that goes in your health kit. This is the normally FDA-approved things that are, of course, certainly all the HIV drugs will be included in there. Pesticides, be careful. There's also PMI, President Malaria Initiative, which has spraying, bed nets, all that kind of stuff is very closely monitored and managed. You don't see much of this used equipment, excess property, and then finally fertilizers, which normally goes with agriculture. So a lot of this stuff is you're not going to buy, but certainly pharmaceuticals and motor vehicles, you probably will. So be extremely descriptive of what especially if you're buying the pharmaceuticals, right? You got 10,000 people on treatment, then we're going to need so much ARV. Okay, so a couple final categories: subawards, subgrants, subcontracts. We could spend a lot of time here. We're not, but let's just say if you've got other people as part of your team, especially if they are part of the delivery of let's say the PEPFAR programs, you need to be very descriptive of what they're doing. And as I said before, remember being able to break out your project into what the subawardees or subgrantees are doing and what you're doing, and again, which sections, because later on, USAID the mission may say, no, we don't want you to work with those guys. We want you to work with someone else. So again, you may have to chop out your subawardees out of your award. And then finally, your consultants and independent contractors. These are people who are normally providing goods or services versus necessarily the results of the program. Okay? Make sure you justify that very carefully. What are they doing? In the cost principles, there's something called professional services. And to justify those things, you need to make sure exactly what they're doing, very clear. Our auditors, our doctors, our lawyers, our specialists, what are they doing? How much time? At what rate? Very clearly defined. Okay, then other direct costs. These are the sort of the catch-all category for things that, as you say, don't fit neatly into the other. Because I don't want to go back up now, but normally there's 6 or 7 line items and then ODC. So as we say here, it's all the extra stuff, the rats and mice we call it: rent, utilities, internet, IT, even your marketing and branding. You've got to do special sort of ways. We're going to see marketing and branding is hugely important. All of this stuff can be covered under other direct costs. Okay. Okay, and again, here's an example of, so rental, and so great. We have an office that we share between the USAID project and someone else, either another U.S. government project or EU, DFID, Global Fund, Gates, whatever. And U.S. government will pick up their fair share okay, but only their fair share. So in this example, there's 20 desks. You know, it's normally done on space or usage. So if it's $2,000 a month and you use 10 of the 20 desks or half of the space, the U.S. government will pick up 50% or half of the 2,000. Okay? That's an allocation methodology that's important to do it fairly and consistently, fairly between your USAID project and other projects, consistently between the years. Okay, I know there were some hands up, so we'll take a quick break here. How can we help someone?
Yeah, hi. So this is Debbie Khalil again, just to jump in and voice one of the questions that came in from BPDO in Ethiopia. The question was, how can you easily identify items in the other direct costs? In the example you shared, Doug, in the sample budget summary sheet, it seems to combine some administrative costs like office stationery, communications, and all training, sessions, and M&E costs. Is it okay to merge these, or how do you show the differences in that category?
Okay, good question. Well, there's generally, let's go back up to the summary budget. There's only going to be so many of these line items that are the large things. Okay, so the ODCs is where you have to define everything else, and there could be 20 or 30 items down here. It is important, one of the next sections we're going to talk about is recovering all your costs. So if you must incur those costs to be in business, then that's where they'll go, ODCs. So I can't say, I mean, you see there's no rent here, but most people do have to pay rent. So it's got to go in here. You got your audit costs. You've got your, costs for IT. All these things have to go somewhere. So that could be quite large and quite inclusive, but be descriptive. Describe why you're incurring the cost and why the project has to pick up its fair share.
Okay, thank you, Doug. Any other questions? I don't see any right now, but feel free to type them in, ideally in the Q&A along the bottom of the Zoom screen there, right next to the participant icon, there's a Q&A icon. So if you type in your questions there, that helps us keep track of them later. And if you can't find that, please also, you can use the webinar chat box. And before we jump into the next section, Doug, I also just wanted to see any other input from CFO or OAA or others who are on.
None from CFO.
This is Adrienne Shade. I just want to thank Doug for giving such a thorough explanation of the costs, and just another reminder for budget narrative is to have as much information about how you came up with the cost per line item.
Great, thank you. And I just see two new questions in our Q&A section. So yes, the video and slides will be available later, and we'll send them out after the webinar. And then the other question from Andrew Tumbo was, during the budget preparation, once you have budgeted for other direct costs, does this mean you cannot account for 10% de minimis?
Okay, good question. This is, I'm not saying a gray area, but you can't double charge the U.S. government. So there's not a lot of guidance on this. We've been working for 2 years and trying to get as much as we can. Let's assume, right? I say to protect the U.S. government, however, still to protect the recipient, to do the fair thing, and we'll talk about this later, I believe that recipients should be as descriptive as possible when you are budgeting up front, which means if you look at the slide that's up right now, and especially this thing, get to know what you currently do not know, okay? Meaning you want to charge certain costs, but even now as a new recipient, you don't even know they're available. You don't know that certain types of training are available. You don't know you can recover certain costs for health or whatever, and so you don't put it in. So later on, you're going to say, oh, I need it. Okay, well, when we get to the 10%, and we're going to talk about why it was designed, it's not, I don't think it's really fair to USAID if all of a sudden you get your ODCs, you get your 10%, and then later on, you're asking to add 8 ODCs to the budget. Okay, so we'll talk about it again, but let's just assume up front you want to understand as much as possible what costs you're going to incur. Okay? If you don't know, maybe you're new to a country or you're new to USAID, talk to one of the bigs, you know, the FHIs, CARE, Save the Children PAC. Talk to the big guys to say, what are we missing? There's no reason they're not competing with you, so they, you know, they should help you, or work with your AOR, your potential AOR, to say, guys, what are we missing? Okay, but we'll come back to that again. Sorry, go ahead. Do I hear something?
Thanks, Doug. Yeah, and I think the 10% de minimis is a question many people always have want to understand better. So I know we'll cover a little bit more on that. One other question that came in is, what are the criteria for an NGO to benefit from indirect costs?
Yeah, it's a one-day course. It makes it easier for you to recover. No, first of all, certain costs can only be recovered indirectly. Okay, so for example, bid and proposal costs. For you to propose, it is allowable as an indirect cost. It's not allowable as a direct cost. Okay, so there are other types of costs also that are logically indirects or very difficult to allocate. And so if you've got adequate accounting systems, then indirect costs, and if the mission is allowing them, which many missions aren't just yet overseas, then but if they are, then it's better to indirect costs if you can. I think we'll spend a little bit of time on that, but that's quite a deep subject.
Okay, I don't see any other questions at this point. So let me just see. Oh, sorry, one more. A couple more came in. Sorry. So how does a prime determine a management fee to be charged when managing subgrants?
Okay, so subrecipient management is part of your mandatory standard provisions. Let's also take this note down, 2 CFR 200.331, managing subs. Okay, you're responsible. One of your responsibilities as a prime to manage your subs. So let's go back up to your budget here. Okay, you should have people, not necessarily the key program manager, but you should have a subrecipient management team or person or a percentage of a person to manage the subs. Okay, that's part of your responsibility. So you put it up in the budget. The time and effort to manage subs is a absolutely allowable cost. Okay. So for sure, that's there. But if you don't know that, and a lot of people have no, I mean, we're talking generally about new local partners who are probably, you know, new as a first-time recipient. So you're a prime, well, that's great. Okay? Being a prime with subs is a lot harder. Okay, so don't wish to become a prime with subs, you know, right away, because it comes with a lot of responsibilities. And if not only not knowing how to manage them, but how to cost those subs is tough. Okay, so that's subrecipient management is, we can do a whole webinar on that if you'd like.
Yeah, I think that is a good suggestion for follow-up to go deeper on that topic. But one other question related that came in is, when developing the budget, can a prime involve the sub, or the sub will just get the budget later? Does the prime involve the sub partner in budget development?
I think absolutely. If the prime has a consortium partner or a sub, the prime must incorporate the sub, because they have to, you know, they have to be aware. First of all, they have to make sure those costs are going to be allowable, because they're part of the consortium. Remember, the U.S. government has a relationship with the prime, not the sub. So it's in the prime's interest to make sure what the sub's putting forward is reasonable, allocable, allowable costs, and again, fits in with the overall project purpose. So a prime maybe has a state or a region or a specific task. Well, that's for the prime to manage and to make sure that, you know, that's going to complete whatever the consortium solution is. So it's critical the prime and subs work together.
Okay, so I think that's all the questions. So wait, one more, sorry. Following up on the sub management fee, are there any specific reference on section of 2 CFR so we can read more about this?
Yeah, 2 CFR 200.331, that's managing subrecipients. There's 8 items in there, and basically under D and E is where it's going to be the sections on what they must do. They must assess, they must strengthen, they must train. The prime's responsible for the sub. Okay, you can't just take someone and say, well, you know, guys, you know, go for it. You're a prime. You are responsible for strengthening, training, managing, overseeing, and again, paying, and making sure the costs from the sub are going to be allowable. So huge responsibilities there.
Great. Those are great questions, I think. And if you missed the exact reference that Doug said on 2 CFR, we will surely summarize these questions and send back the responses in writing to you all. So you'll have that for reference later. So thank you very much for the questions coming in so far. This is really great, and it's helpful to hear, what you're interested in, and we will for sure note a webinar on the sub-partner management for follow-up. So Doug, I'll turn it back to you to keep going so we can get through the rest of the content.
Great, thank you. Okay, so again, a lot of people concerned they're not recovering all their costs. Well, you need to, again, go to the CFR. That's why I'm saying ecfr.gov, and particularly in the 400 section now, so we're in the cost principles section. And this, the U.S. government's very clear. It's not just USAID, it's the entire U.S. government plays by the same rules, where they will pick up their fair share of the costs, but again, all costs have to be reasonable, allocable, and allowable. Okay, so the first point is, this discussion now is about allowability, but you have to know what you can charge the U.S. government. And it's a little bit tough if you're new to the party and you didn't know, or you've never been a partner. So certainly make sure you understand the structure of your organization as it exists before you become a partner. And then understand, the whole point about budgeting is understand what you're going to have to do to comply under the award. And so you read your agreement. I mean, you might even if you're just proposing for the first time, nothing stops you from getting the mandatory standard provisions and understand the types of things you're going to have to comply with, tax reporting, various data submissions. All these things take time and sometimes money. Okay, certain security over your IT, those types of things, and certainly the cost principles. So what it's Donald Rumsfeld that says we don't know what we don't know. Here, you need to know what you currently don't know, so you do know, and then you will be able to charge the U.S. government its fair share. Okay, so what the allocability principle talks about is that you a cost to a particular project. Okay, you'll be able to allocate the cost of the project in relationship or in relation to how much that project receives of your cost. So the early example that Adrian talked about, okay, we had rent of $2,000 a month. Well, if your project has half of the space, then the project will pick up its fair share, the relative benefit, half the space of the $2,000 bucks. Okay. Now, there's 3 types of things to consider here, and most people only focus on the first 2. The first one, and this is again 405, incurred specifically for the award. So if you must incur the cost, certainly USAID is going to pick it up. Again, a thousand orphan beds. Well, if you have to have 1,000 beds, that's specifically for the award. That's a no-brainer. The second example is costs like rent that benefits both this award and other work of your entity. You are non-federal entities. You can be called NGOs, not-for-profits, and what many things, but from U.S. government speak, you're an NFE, non-federal entity. Okay, and so again, one more time, you will be distributing those costs in proportion that is based on some basis. So the rental was based on space or square footage or desk use, assuming desks are equal size. That's a reasonable method. So again, that would be maybe your rent, your power, your water, maybe your security, other types of costs that allocable to that your project uses. It's the third type here that many people are missing. Okay, and this is where right below here is what the USAID rule states in your mandatory standard provisions. Literally, number 1, the first provision. Okay, says it's your job, recipients, to make sure the costs are reasonable, allocable, and allowable. Okay, so we've talked about reasonable and allowable before. We're talking allocability now. But here USAID says, and I'm not saying I disagree, I'm just saying I'm not sure they're being clear enough. It says incurred specifically for the award. Okay, well that could be these first 2, incurred specifically for the award, and allocable. And many people say, well, okay, that's what your ODCs are for here. Rent, or communications costs or things. They're sort of, I'm not saying they're forgetting, but they're not highlighting this third point. And this is the point we're going to spend a few minutes on. Okay, the rule for the U.S. government is if you must incur a cost to be in business, to operate, they will pick up their fair share. Okay, so let's see on the next slide if I have some of these. Okay, so let's just say you must have, and frequently, let's go to the next slide. Okay, frequently you have to have a statutory audit, your local audit in Ethiopia or Kenya or Uganda or wherever. If you must have that, then the U.S. government will pick up its fair share. Okay, frequently when we do NUPASs, when ASAP does NUPASs, you know, we check to see, okay, is your structure correct? Do you have proper internal controls? Do you have board meetings, proper directors? Well, if not only in countries that, you know, many NGOs must have boards that operate and properly manage the NGO. Well, if you have to have that, then the U.S. government should pick up their fair share. Okay, so a lot of times recipients reach out to your AO. Again, your accounting costs, your normal, maybe you outsource your accounting or things like that. Maybe internal audit. You don't have enough, you're not big enough to justify an internal audit function, but we need these sort of services. You must register with the ministry to be a registered NGO. You have to incur these, otherwise you can't operate. The U.S. government will pick up their fair share. So that's what this one is. It's necessary to operate in wherever you're operating. Okay, quite important. Okay. Next, understand how much things cost. Frequently, new partners don't know how much stuff costs. So earlier, one of the people asked about grants management. I got subs. Yes, you're going to spend time and possibly money on those people. Your Yellow Book or GAGAS audit will be more than your statutory audit, for sure. Okay. Again, your compliance requirements, all the things you have in the mandatory standard provisions, they take time and sometimes cost. Okay. And frequently, now we had in an earlier discussion, a webinar, people said, well, you know, if I have to find people who are experts, they're going to cost more than the average person in pick your country. Well, that's true. That's true. And so you have to be aware. You can't just say, oh, I've got a compliance manager and she or he should cost whatever, $5,000 a month. Well, maybe they're so short that you're going to have to pay $7,000 for it. So again, figure out the market for your people and make sure you're budgeting correctly. Okay. As I said earlier, talk with other NGOs that are working in this space. And again, there's no reason that they won't share with you, I would hope, unless they're competing with you for this specific project. But in general, there could be some big folks who are willing to help you. Okay. And then finally, certain costs are not allowable. And these are defined in the cost principles. So we say, read your principles, but alcohol, not allowed. Bad debts, certain types of entertainment, again, personal use, goods and services, fines and penalties of stuff, lobbying, generally not allowed, certain taxes that you could avoid, these are not. Okay, so again, read your cost principles, know what you can charge, and more importantly, read what you cannot charge, and then don't charge those. It makes you look bad if your proposal has costs that are not allowable. Okay, I'll take a quick questions there because allocability could be quite a discussion point.
So again, this is Debbie Quill. Please enter in any questions. I don't see anything new, but if anyone has anything, please enter them in on the Q&A box, or feel free in the chat box if you can't find the Q&A box.
Okay. Great.
And while we're waiting for a second, anybody, any other colleagues, CFO, OAA, want to chime in and add anything?
Chris Nicola here from OAA. I just added a response to a question about the de minimis rate. There is a resource on our website. I shared it to an answer from Andrew. So if you want to take a look at it, it's a link and it's a PDF infographic on the recovery of indirect costs, and it kind of goes a little bit into the de minimis rate. So just FYI to take a look.
Great, thank you, Chris. And we'll be sure to attach that also when it goes out for everyone afterwards. Okay, I don't see any, oh wait, just a minute. Okay, one question regarding charging rent. In case an NGO owns property, how do you recover rent for a project or depreciation costs?
Okay, well, that's the answer, actually. If you own your own assets, and that could be your vehicles, your computers, your generator, your building, you are allowed to charge the U.S. government a depreciation charge. Now, that is in the cost principles, as well as the mandatory standard provisions, I believe. But so rent, you would, well, it used to be called a use charge, but the whole point is here, if you own your building, yes, you can depreciate, obviously using a fair basis, probably 40, 50 years, but you can depreciate the cost of that building and charge USAID.
And thank
There's
you.
a whole principle on that.
Great. One other question, buying office furniture like boardroom table, chairs, et cetera, are those costs allowable?
Well, you're in existence, so why do you need new ones? Frequently guys say, yes, we just got our $10 million, let's upgrade everything. Well, is that prudent? Remember the prudent person rule we talked about earlier, under what's allowable. You should be prudent with your costs. Do you need it? Okay, and again, are you only working for the U.S. government? Are they going to pick up 100% of that, or do you have other projects? Is the Global Fund, Gates Foundation, EU, are they picking up part of that? So yes, that you can buy equipment, put it in your budget. I think your AOR might be asking you, okay, and again, are we picking up the whole thing? So you might charge, you might get those assets, and are they? Let's just say this: if they're specifically for a project, so maybe you're opening a new a place out in the rural area, and you got to rent a new place and buy equipment, furniture. Yes, that would be a direct cost. But home office headquarter furniture, I think you need a discussion.
Thanks. Another question, you mentioned on the shared cost, for example, like 50% of the rent. How is it included in the budget and report for the project?
That would be, as I think I'll just jump back into there, as an example of, I've got my office rent here. So again, it's $2,000 a month. Thanks, Adrienne, again. So in that place, we have 20 desks. You could say 20 desks, or say we have 2 floors, okay? Regardless, we've got 2 floors or 20 desks. 1 floor or 10, half of the desks are for people on the USAID project, and the rest of it is for, let's just say, another project. So again, the U.S. government, USAID should only pick up their fair share of that 2,000. The logical basis for space or for rent is square footage or meterage. How much space does your project use? Why you can't charge the U.S. government the whole $2,000? And frequently, this is what happens. People, they budget for a building, okay? And so they budget the whole. So they budget here. Say you budgeted $2,000 for the project per month, and then you get the building. You don't use it all, and then you get an EU project, and then the EU moves in. You don't charge USA $2,000 because that was in the budget. You must charge the actual fair allocable cost. Okay, frequently people charge budget, saying, well, I had it in the budget, so that's allowable. No, it's not reasonable. It's not allocable. You can only allocate, you can only charge the U.S. government its fair share, in this example, 50%.
And Doug, a follow-up question that's sort of related, that asks, if we, for instance, allocated 40% for shared costs for personnel, like specific personnel costs during the budgeting, but then the actual contribution of the staff was 60%, is there a possibility to pay this 60% of the salaries?
Okay, there is a lot of flexibility in moving money between budgets, okay, budget line items, okay? It's actually 10% of the total budget for the entire project for all 5 years. So we're showing, what are we going to show here? Sorry, back to here. Okay, so say this is a year 1 budget. So the total is, let's say our direct costs, U.S. government costs, $312, and so next year's $480. So in general, this might be $1.5 million project. Okay, conceptual, not even conceptually, the rule for USAID is any organization can move up to 10% of the total budgeted cost for the project between line items. So there's no shortage of potential money to move between line items. The question is, what are those people doing? So, okay, we budgeted 40%, they're charging 60. Yes, you're allowed to charge actual, You know, but if that was for the project for all 5 years, you're going to run out of money. Okay, but in this particular month or two, remember it's for the year. So in 1 month they might be 60%. Next month they might be 30. Yeah, no, there's no problem with that. Charge 60 the first month, whatever, 40 the next month, 30 the next month. Charge actual. The most common finding for auditors is people charging budgeted on the timesheet versus actual costs. Finding number one. Okay, so don't do that. So the allocability of indirect, I say indirect people, that could be, that's a further discussion to say, okay, my IT team or procurement or HR or finance, allocating those, that's a bigger discussion. But if you're talking about the guy who's supposed to work on 2 projects, the M&E person, and she's 50-50 in theory, but during that month she works, 60% instead of the 50, charge the 60, charge actual.
Great, thank you. So either way, undercharge actual, overcharge actual, right? It's just charging the actual amount, right? Okay,
Absolutely.
another question we had back on the depreciation. Do you charge depreciation based on useful years of asset or the project period?
No, it's a useful life of the asset. The U.S. government only picks up its fair share of the costs during their period. So if a building could be, again, building is normally over 30, 40 years, or a vehicle, say, is 5 years. And you buy a vehicle and let's say halfway through you need a new vehicle halfway through the project in year 3. Well, you're going to bill it, it's, 2020, 2020. So it would get its life of use charge.
Thanks. Okay, one more. If an allowable cost has been overlooked during budget preparations and approval, but during the project implementation, can one be allowed to claim the allowable costs as may be part of reasonable cost for project implementation?
Yeah, okay, well, that's good question, and that's going to happen, especially for new IPs. So, you did your best. So again, that's why we say do your best, identify what you know and don't know, try to do it. Then when you have a new cost, you're certainly not going to have, every direct line item in the ODCs of what you have. So the concept for allowability is any cost is potentially allowable if it's not specifically unallowable, like alcohol, bad debts. Okay, so if you incur the cost, it's an allowable cost, it's reasonable, and you can justify why you needed to incur the cost, in theory, you should be able to charge it. But do you have the budget? At the bottom line is if you don't have the money, at the end of the day, if you don't have the money, you could have a problem. So reach out to your AO and say, dear AO, sorry, we didn't realize we had this cost coming up, but in general, you should be able to charge it, yes. You're not precluded from charging. There could be, it could be volume issues. Do I have money in my budget? Again, I'm happy for Adrienne or Walter, anyone to jump in there on that one.
Yeah, this is Adrienne. You definitely have flexibility within the line items. So we had used the example of beds or cots, like 100 cots, maybe per facility, and there's 5 facilities. So in your budget, you had 100 cots per facility, 5 facilities, that's 500 cots. Well, when you get to the facilities, one might need 80 cots and one might need 120. And that works out to an average of 100, and that's fine. And at the end of the day, maybe you actually need 510 cots. You didn't budget for it, but you can charge the 510 cots. You just have to be mindful of where the money for that extra 10 cots is coming from. And typically on budgets, some things you might budget $100 and it works out to be $110. Some you budget for $100 and it works out to be $90. So you should get a little bit of cost savings on different line items. So if the cost savings on some line items makes up for the 10 cots, great, no problem, go ahead and buy them and you can charge them. It's really if you're going to be taking money from personnel to buy cots, or if it's gone from 500 to 5,000 and you just don't have enough money in your budget and you're going to need an increase to your overall budget. That's when you need to be talking to your AO.
Great. Those are helpful points. Thanks, Adrienne. I think at this point we have no more questions. So Doug, we'll let you continue on, and then please, if other questions come up, continue to put them into the Q&A section, and then we'll answer them at the next break.
Okay, thank you. This is just I'm just thinking here, we got to be very careful. Okay, direct and indirect, I've only got one slide because, again, this is like a rabbit hole we could go down and spend all day on. But there are differences between direct and indirect. Again, in the uniform guidance to CFR 200, at 413 is direct costs, 414 are indirect costs. Certainly start there. I think what Nicola had said was earlier about the 10% de minimis. Some of that discussion probably relates to indirect costs. That could be helpful. Okay. Conceptually, you should try to direct costs as much as possible, because direct means you're justifying it. Again, 1,000 cots or 100 cots or 100 bed nets or whatever drugs you need. Okay. If you can allocate it specifically to the project, do that. And even like the rents and like you talked about, all that stuff directed. And then we're going to talk about de minimis in a few more minutes. But after you've done all of this sort of direct costing, then you want to make sure you're requesting your 10% de minimis. And again, we'll get to that. But our very first question asked about indirect costs, at some point, depending on your maturity, and again, depending on the mission's readiness to give you, willingness to give you an indirect cost rate, then you may wish to go there. Okay, the bigger you are, one of the earlier AOs in my career said, indirect cost rate is a sign of fiscal maturity. Okay, if you can have an indirect cost rate, not only are you going to recover things you can't recover directly, again, the classic example is bid and proposal costs, but your life will be easier. Okay, but that's not this discussion. So but you do have to break stuff out into direct and indirect. Okay, and as I said earlier, if you're not sure, ask your AO. That's why I said at 407, there's the reference that we talked about. You can get prior written approval. And it's not, the whole concept here is the logic, which is also at M1, as we say here, right? USAID asks you, instructs you. If you don't know, ask. If you're not sure, ask. Because USAID doesn't want to give you money and take it away from you. That's not the game. They give you money to spend it correctly. Okay, MTDC is the basis upon which you will be charging the 10%. So think of it as, and this is it's a very specific description. Now this was created by the OMB people. It's called COFAR, the Council on Financial Assistance Reform, and it's at 200.68. So if you go to ECFR, you'll find this there, and it's very clear. They say MTDC means or includes all these specific items. So salaries and wages, okay, of normally your people, the doctors, nurses, people doing the good work, what I call saving lives, okay? The fringe benefits on those people. Material supplies that you need to do your project. So your reagents, your kits, all that kind of stuff for your patients, if you will. Okay, the services around that. You might need to hire certain things or have certain type of activities that you outsource, not necessarily get careful about contracting here, but just general services for your activities, okay? All the travel. And only up to the first $25,000 of each of your subawards, okay? And that's $25,000 for the entire life. It could be a 5-year subaward. Only the first 25 of that is included in MTDC. So that's what we call the base. If it was an indirect cost rate, that would be your base. Your MTDC, modified total direct cost, is the base upon which you are going to get your 10%. What you cannot include in MTDC, and therefore you're not going to get the 10%, means it excludes equipment. So yes, you bought a generator. Well, you're not going to get the 10% on that. Okay? Capital expenditures, you're doing buildings and stuff. You're not. Patient care, no. Rental. So you rent your building. Why is the U.S. government going to give you 10% on top of the rent? No. Most of us don't have tuition remission, scholarships or fellowships, and then participant support costs, you might have some of those. Okay? These are all not included in the MTDC or the base. And then the remainder of the 25 that you had here, the remainder, everything over 25 is excluded. Okay? So going back up to our budget back up here at the very beginning, okay, you're going to have to assess, are these things included or excluded in MTDC? The reason I've highlighted this one in red, Walter and the team, I'd love to, I mean, this is an endless discussion with the AOs that I work with. You know, contractual is a gray area, okay? And so just notice this. All I'm saying, guys, is equipment, that would be excluded. Travel, probably included. Fringe, again, it depends. Are these people direct costs? When I say direct or indirect, but you know, there is a little bit of understanding one has to do. And basically the ODCs, again, what's in there? So if participant support costs are in here, they'd be excluded. Okay? Rent, excluded. Equipment, excluded. And so the rest of these. So getting back to MTDC, that's what you're going to have to do. You're going to have to go through all your costs and determine, are they in this or this? Now, unfortunately, Gil Tran and the guys, he's the guy at OMB that sort of created this, or at least defined it. They're not willing to add or to subtract to this. They say you have to figure out recipients and missions, you know, is it included or excluded? The reason I'm saying that, Walter, is in the original it was $25,000 each subaward or subcontract in the original uniform guidance, but they took it out a couple months later. So my belief is that they took it out of here, then it is included, subcontracts. Okay, regardless, folks, that is the definition here. Okay, so the 10% de minimis will go on top of the good parts of your, I said the good parts, the allowable parts of your budget. So be careful, understand all your costs in your budget, try to include them all, and then determine which ones are inclusive, which ones are exclusive, add the 10% on top of the MTDC base. Okay? At 2 CFR 200.414F here, it explains the 10% is an election. You elect to do this. And the missions are generally allowing, if you ask for it, with the proper calculation, saying, here's my calculation. I'm citing 414. I'm asking you to let me have this. The rules say they should give you recipients. You should get this from the mission. Some AOs might say, no, just to continue to direct cost everything. Well, I mean, if they say that, that is your AO. You must listen to your AO. But but generally, I would assume you want to elect the 10%, and then you have to manage it. Okay. Again, I'm talking about NICRAs here. So again, that is in the mandatory standard provisions. We talk about, well, NICRAs are there. We're not going to talk in NICRAs in this class, but the 2 CFR 414F is where the 10% is specifically mentioned. Just go there. Okay, the other point is that generally, even though the uniform guidance states that you can elect, once you've got your 10%, you can elect for a NICRA. Again, the missions are hesitant to necessarily issue NICRAs for a number of good reasons, and one of those is necessarily the auditors aren't ready to help you when it comes to audit time. So there's still some learning to be done around NICRAs. Okay, this is many people have never seen this. Many people don't get to page 78,600 of the Federal Register, but this is where the COFAR explained why they created the 10% de minimis. Okay, so if anyone wants this, I'll happily share it with you. But what it's talking, this is in the preamble to the uniform guidance when it first came out, and in that preamble they were explaining to all the agencies why they did what they did. It was like the Q&A for the new uniform guidance, and they were talking about the new creation of this 10%. And so as we said, at 200.414F, that's where they're explaining what's happening here. Okay, so just read it. Okay, any non-federal entity that has never had a NICRA, which is most of you guys overseas, may use this 10% de minimis of MTDC. Okay, now here they're explaining. So when the uniform guidance was put out, everyone had the opportunity to comment. So many organizations and people and agencies commented that it could be higher. Why don't we make it 15 or 20? Okay, so but the COFAR, Council on Financial Assistance Reform, they were basically they decided on the 10. Sorry, let me just back up. the reason they gave the 10% de minimis is because smaller organizations, like many of you of our non-US organizations, don't have the capacity to conduct the negotiation, or the missions aren't giving them, okay? So what they're saying is this 10% or whatever they decided on was eventually going to be the de facto or de minimis rate. So it was like your baby NICRA. Okay, it's like it's considered a baby NICRA or junior NICRA. Okay, so COFAR said that they considered raising it, but kept it at 10. But this is very important because the de minimis rate without analysis of actual costs, it's not going to be audited. The 10% de minimis is not audited, which causes other headaches. Okay? But because it's not analyzed, it should stay at that conservative 10% level. Okay, so one more time, 10% of the modified total direct cost is your your de minimis rate. Okay? Now to do that, I see we have Michael has a question here. It can come up. I'm just saying here, this cost policy statement. So again, I'm not going to get into indirect costs, but in the guidance and again, I can attach it, or our AORs or the ASAP team can attach it. There is something called a cost policy statement in the USAID guidance, and this will help you understand, are my costs direct or could they be indirect? And again, your job is to try to, I say your job, you'd prefer to charge as much as you can directly, and then basically try to direct charge cost, ask for your 10%, and then properly manage it. But my goal is protecting the U.S. government would say, hang on, guys, don't go weak on your budget. Ask for the 10%, get it, and then start saying, oh, sorry, I forgot to put my stuff in my other direct costs. I don't think that's fair to the government. Okay, I will probably stop there. There could be some questions on de minimis or other comments from Walter, Adrienne, or anyone.
Thanks, Doug. One question that's come in is, would you have to pass an audit in order for the AO to approve the 10% de minimis?
No, not at all. As a matter of fact, the guidance says the AO, the U.S. not USAID agencies should not expect people to define what they're going to use the 10% for. It's actually saying the government's not supposed to ask that. We can provide that. Certainly the guys in Ethiopia will get this next week, but that's in the COFAR Q&A, the third version. So there's three. I'm happy to share that in the Q&A later on, but there's a lot of guidance on this 10%. So the short answer to that is no. It's certainly that you don't need to be audited before you get it, and you're not going to be audited after the fact, which is very different from the NICRA. The NICRA is audited.
Thanks, Doug. Is the prime required to provide detailed accountability with supporting documentation for the indirect cost rate, the 10% de minimis?
Well, you're asking, is the prime required? No. I mean, the 10% is an election. The COFAR guidance says you don't have to say what you're using it for. I know some of you have CDC funds, so it's a little bit different there, but the answer here is no. Now, the AORs may say, and the AOs may say, well, you have to, but that's actually the rule is they don't have to. But again, I'm going to put my auditor hat on and saying to protect the government, I don't feel comfortable I don't think it's fair that the recipient does a poor job of budgeting, gets the 10%, continues to get it, and then starts adding back costs in that I would think logically should have been included as ODCs in the first place. So do a good job budgeting, take your 10% and live with it.
Another question is, at what time or what stage of the project should the 10% de minimis be required?
In the initial response back to our solicitation, you should identify the method of how you're recovering your indirect costs, and one of which is the de minimis rate. So make sure that it's early on identified that it is de minimis rate in your application.
Thanks, Chris. And a question from BPDO in Ethiopia. What are the major requirements to have the 15 to 20% NICRA and the documents needed to utilize it?
Okay, that 15, okay, that what I showed earlier is not a NICRA. That was a discussion on what the de minimis amount should be, a rate should be. To get a NICRA is a reasonably complicated, it's a complicated exercise where you have to analyze your, that's what this cost policy statement is. You have to analyze your, first of all, you have to have your statutory audit. Let me give you the 1-minute version. Statutory audited financial statements is the starting point. Okay, you have an organization-wide NICRA, negotiated indirect cost rate agreement. You propose following a reasonably structured process to USAID, including this cost policy statement. And the mission overseas are the ones, the AOs are the ones who would have to approve it. And to the best of my knowledge, right now, Ethiopia AOs are not approving, and I don't blame them, indirect costs because they are complicated. But it's possible, but unlikely.
Thank you. And here's a question as a sub. If I understand correctly the question, if a prime requests for the 10% de minimis accountability, how do we go about this? Are there any references?
Yeah, in that guidance that I talked about, of the COFAR guidance, it does state that that is not determinable. And I'll just go back to here. COFAR considered, giving more, but ultimately, as you can see here, without analysis of actual costs. So you're not, that's the whole point. I mean, I heard what Chris just said. I think that those indirect costs may have related to people who are charging stuff as ODCs. Of course, that would be, but to the best of my knowledge and reading all the guidance and trying to clarify with COFAR, that 10% does not have to be justified. And I'll share that with you post conference.
Thanks. One other question we got in is, what information is needed in the budget notes regarding indirect costs?
Okay, so let's clarify a NICRA which is complicated versus ODCs, which a lot of times that's going to be down here would be, it's not really that's where we can get confused about direct or indirect. Other direct are the types of things that you're allocating. So for example, rent. Now, a lot of people think, well, rent is, indirect. But here it's going to be in other direct because we're allocating it fairly, logically, on a consistent basis. Okay, so that's where I'm thinking people are thinking other direct equals indirect. Okay, but if you actually had, and I say here indirect costs because this is sort of the 10%. If you had a NICRA, it would say down here basically NICRA, or I'll say indirect as we say indirect costs here, but indirect costs. Let's just assume indirect costs are other direct costs certainly for the guys in Ethiopia. I don't know if someone else wants to jump in there. Anyone, certainly Chris or Adrienne or Walter. Okay.
And we can follow up and get additional input too to respond more fully. Another question came in, does CDC use the 10% de minimis?
CDC allows 8%, very unique. You could do, and it's only actually for, I might be able to give this to you here. I don't know if you can see if I'm flipping between.
Yeah, we can see.
You see a bar. Okay, so here is working with someone today. So the CDC version of the uniform guidance is at chapter 45 CFR, and theirs is 45 CFR 75. And here it's the same 414 section. You can see. If you can you see this on your screen? Okay. Okay. So here you've got up this. I'll call it the Health and Human Services CDC version of 414. Okay. What they have is unique. You won't find this in, I'll call it the USAID or our version of it. Under C, which is federal agency accepted of the NICRA, under 1.2 here, sub 2, it says indirect costs on grants awarded to foreign organizations, meaning non-U.S. organizations, performed fully outside of the U.S. may be paid to support the cost of compliance up to a rate of 8%. So that is what they did to quell the screams from overseas saying, why can't I get my 10%? This is, I don't want to go too deep into it, but NIH, which does a lot overseas, always offered the 8%. Okay, so CDC, now they may not give you that. You're gonna have to fight for it, but that's what you should be asking next time you're budgeting. Cite this, 45 CFR 75 414. Obviously, you're getting down into the weeds now. C122, double I.
Thanks, Doug. Yeah, and important because sometimes partners receive funding from both USAID and CDC, so it's useful to know the difference.
Yep.
Okay.
But you got to ask for this. Good.
Go ahead.
Okay.
I think that's all for the
Okay.
questions I see right now. Any inputs from Chris, Adrian, Walter, others on the line?
None from me.
None for me either.
Okay. Great. We'll continue on, Doug.
Great. Well, I appreciate the input of the wiser people because they, you know, and again, they are the U.S. government. So cost share. We got to be brief. You only have about, what do we have, about 10 more minutes here before Q&A, I think. Just want to make sure we're doing the time correctly. Okay. So what we have left is cost share, financial reporting, pipeline. Okay. So cost share, you may or may not have cost share as part of your project. And as Adrian helped define, the most current guidelines say your award will define an amount, but that the U.S. government is going to fund, expect you to provide. Okay. Historically, it's been 10%, but it could be less, could be more. Okay. But assume it would, if it's going to be anything, it's probably going to be 10% of your budget, which says the U.S. government says, great, we're giving you X. $1 million, we expect you to come up with generally 10% or 100,000 to support the project. Okay. Now they will tell you whether there's two different potential ways they say. They could say it's an annual requirement. So if we zip back to our original show here, it says it's an annual requirement. So you know, my cost share in year one is defined. Okay, it's defined as cost share. My year two, it's also going to be, I just made it 10%, but basically it is defined as an amount, okay? Then you're expected, that would be an annual requirement. And in your audit, there's a certain type of format you have to use to explain that. More often than not, though, it's a life of project amount. So they may say, great, we're giving you whatever, $1 million for the project, or $1 million a year, or $5 million for your total, and therefore you have to come up with $500,000 over the life of the project. Okay, so in that case, there's a specific format that you would use. Okay, again, I'm happy for anyone else to weigh in on what they prefer, but most of them seem to be life of project right now. Okay, so the concept is the U.S. government wants you to use not their funds, but any other source of value for the project. So here's the example of depreciation. You own your building. Well, maybe instead of charging the U.S. government for it, you allocate that to your cost share. Okay? Or you've got DFID, Gates, Global Fund. All those projects are doing something that assists your project achieve its goals. Those could be also deemed as cost share. Okay? Other types of activities, services. You can go over here, contributions from other people, in-kind contributions, volunteer services from the nurses, doctors, the government employees who are helping you, making their buildings available. You work out of a government clinic. You use government vehicles, their equipment. All of that is acceptable cost share. Okay. Now, but from an auditing point of view now, what we will look at is, okay, show me how you justified that you supported your project, and we will look at these 6 items. Okay, so I'm just going to say, you know, my classic example is someone says, oh, well, the government provides ARVs or, you know, the therapy for our people. So that's it. We're saying, yeah, but how much? So I got 10,000 people on treatment. Okay, so that's 10,000, that's my number. And how much do those drugs cost or value a month? If you had to go out into the market, you'd have to pay what? $10 a month for the ARVs. So I got 10,000 people times $10,000 or $10 a month. That comes to an amount. Okay, show me how you get to these amounts. then you got to be careful that you're not either double charging, or you can't use your CDC project for your USAID cost share, or state, or anyone, defense, any other agency. You can't use one U.S. government program to support another. And again, these costs must be allowable. They can't be alcohol, bad debts, other sorts of things. Okay, so that's, and the other point, the final point is, you know, they have to actually relate to your project. We had a situation where, you know, someone had an orphan and vulnerable children project, you know, it had nothing to, and they had a cost share, and yet, you know, another project the organization did was, you know, voter registration. You know, there's no correlation between a voter registration project from the EU and a USAID OVC project. So that, whatever, regardless of what the EU gave you on the voter registration, that didn't contribute to your OVC project. So you have to have a link. Okay, and I'll leave it at that because, I mean, cost share, you know, again, you can read up on it. It's in your mandatory standard provisions, so please read up on them. And it's also in the uniform guidance. I don't want to go back to that, but in the uniform guidance, there's specific information on cost share. Okay, realize subrecipients, your contributions can be used by the prime. So prime, when they're creating their consortium, certainly is going to look at, can my primes also add to my, the overarching responsibilities of the consortium. Okay, but if you don't comply, it's possible that your AO could reduce, or even in theory, terminate you or claim for a refund. I don't see that very often, but it's possible. So just be careful. If you're going to commit to cost share, make a plan to deliver. Yeah, I think I saw a hand come up. I saw a green sign come up. So I think we have time for one here.
Yeah, any questions at this point? I don't see any new in the Q&A or in the chat box. I see a hand raised, CO Roland. Are you able to type in the question in the chat box or Q&A box, or you want to speak?
Okay, we can certainly come back to it.
Theo, I can let you talk if you want to ask the question directly, if you're unable to type it in. Let me give you access. Theo, are you able to talk? We may have to come back to it. I'm not sure I'm able to unmute right now. Oh, wait, let me, sorry, one question came in. How do we cost volunteering service?
Okay, volunteers, that's up. Okay, so volunteers, it's important that the value of a volunteer, the value of anything given to a project is the value that you'd have to pay to get that arm's length, you know, sort of in the marketplace. So, for example, if, and this is the, so it's quite important that a doctor, assuming a doctor is more expensive than a nurse, and not necessarily always true, not necessarily more valuable, but a doctor performing nurse services is worth the value of the nurse, not the value of the doctor. Or another example, frequently NGOs have a community come to help them to paint the creche, paint the school, paint the clinic, and what's the value of that? The value is what you'd have to pay a painter on a normal 5-day week, no, not on weekends, not overtime. If you have to pay a painter $1 an hour or $2 an hour, and 10 people come and paint on the weekend, they're worth $2 an hour. Okay, so it's the value of the service, market-related services.
And related, can we use a cost share for volunteers of project beneficiaries?
I'm not sure. Can you use the cost share? I'm not sure I understand that question. Sorry.
I guess if I understand, for volunteers working with
volunteers can be used.
Volunteers working with project beneficiaries.
Yeah, volunteers can be used for cost share. That's a very common use, a very common contribution to cost share is volunteers. Absolutely. The community comes
related. What should be used as a justification for volunteer services, or do you need a justification for volunteer services?
No. I mean, the justification for cost share are these 6 items, but I have to admit, you know, I guess the ultimate one is this number 3 here, okay? What did those volunteers do to help your project? Okay, now in theory also, I mean, wearing my auditor hat, you gotta be careful. How do I know the guys came? Okay, maybe take pictures during the day. In theory, you should expect timesheets, but you don't get volunteers to do timesheets, but maybe just have a sign-in sheet, you know, saying, great, you know, we were all here, take a picture in the morning and the afternoon to show the guy was there all day. You know, that would be sort of, you know, some justification that, you know, that you did get that service. Okay, or, but, you know, well, I'll leave it at that. I mean, you know, frequently churches say to their parishioners, guys, get out there and help the clinic. And so again, you'll have en masse, you know, a group of 40, 50 people coming. Just document that as well as you can. But then what are they doing? Okay, if they're painting or gardening, again, the value of those people is only the, you know, the gardener. And this is one time, you know, it's quite important recipients. Okay, if you want to leverage your auditors, okay, here's a good one. Because your auditors, the value of your auditors, don't have them come and paint your creche or paint your clinic. Have them come and do the books on the weekend. Then the value of that is the value of the actual accountants. Okay, it's not going to be the value of the you know, the volunteer services. It's not painting. If the auditors paint, they're worth a painter, the $2 an hour. If an auditor's come and do your books on the weekend, or some other accountants do, that's worth the value of that accounting service, okay? So that's a quick way to get, you know, go to the private sector and get something as volunteer. It could be much more valuable. Or printing supplies and stuff like that. Sorry, I'll stop there.
Great, thanks, Doug. So shifting from volunteer, but a question on cost share. If a organization has a sub-partner who has a program manager who splits time 60%, 40% between USAID and Global Fund, I'm assuming a USAID funded project and Global Fund funded project, can I claim the 40% as cost share?
Okay, I think for the sub, I mean, assuming the sub has a requirement for cost share as well, certainly whatever the Gates Global Fund, whatever that the other partner's doing would be allowable, assuming it contributes to the USAID project, okay, that the prime is managing. Okay, so in that sense, yes, as it says here, that the subrecipient, that contribution can be used by the prime. That would be my interpretation of that.
Okay, and we can follow up, make sure we check with our colleagues and get a written response as well.
Okay.
And any other questions or any other input? Okay, Doug, we'll turn it back over to you.
Okay, we've got a few more minutes. So I was asked to talk about monthly financial reporting, and I literally want to go to the next slide. Read your award. Okay, in Schedule A of the award, it's going to be very clear. The AO makes it quite descriptive, or if you're a sub, the prime should make it quite descriptive what you need to, how you need to report, you know, financially or otherwise. But this is about financially. So frequently, or especially, I mean, the mission may, again, I can't say there's one global approved way to do it, but conceptually, we'll show one here. This is an example of one of the groups we work with, okay? But basically, monthly, you would generally want to know how much has been approved for your organization, how much have you spent to date, and notice this would be examples of the line items that come from your award or sub-award, because you're monitoring possibly per line item. Okay, so great. My budget for and again, we could talk about obligations. We have down here obligations. So let's say the obligation means the U.S. government has made it, or USAID has made it available to you. Not necessarily just budgeted, it is obligated. Obligation is more specific than a budget. It means it's made available to you to spend. And then, great, how much have you spent so far to date? Okay, and then how much are you going to spend in the current period? Okay, and then you know, some sort of totaling up of the total expenditures, and then you'll have a balance, maybe an unexpended balance, and this sort of thing. Okay, so So a prime may have their own specific template to use. I can't say, I don't know, again, I'm happy for any AO or AOR to weigh in, or Walter, but the concept here is, what did how much money did we make available to you? How much have you spent? How much is available? How much is going to remain? So it enables you to do what we're going to talk about later on, is figure out your pipeline and how fast you're burning. How are you managing versus the budget? Okay. So again, there's certainly, you can go to the website, grants.gov, there's standard forms. U.S. government has a lot of standard forms, but again, read your award. It normally will tell you, or even attach possibly, how they want you to report. Okay. There is a standard form. SF means standard form. There's a whole SF website. Standard form. There's a 425 example. Okay. Many times at the end of it, well, it could be, again, read your award, but it may tell you on a quarterly basis or annually, certainly annually, you'll be submitting this SF 425 Federal Financial Report. There's on the SF website, there's instructions for this, so you can't get lost. Certainly, they'll explain to you how to complete this whole form. I'm going to blow it up a little bit here. Okay. And it's quite sort of, well, descriptive, but it's, if you've got multiple projects, well, I won't even go there. Let's just say the form is here. That's the one. And then there's going to be the second half of it, which is on the next slide down. Let's just go there. Get back to small side. Okay. I'm going to leave it at that. I don't want to get too deep in it. Okay. I don't know if anyone else wants to weigh in on monthly financial reporting, but please realize, guys, this is, someone's going to certify that this is correct. Okay. Be careful. If you're the responsible person certifying for your organization, you are responsible. Okay. So a false timesheet is a false claim. So this is a very responsible position you have if you're certifying for your organization. So be aware that, you, in theory, personally, not even in theory, you are responsible for your organization, that these costs that you're including in here as salary and all these things are real. Okay? So don't take this responsibility lightly. Questions or comments from anyone on that? Okay, again, read your award. It'll be described there. Work with your AO and AOR. If you're a prime, if you're a sub, work with the prime. Make sure they're getting what they need. Because remember, the prime has to report to the U.S. government. You subs are reporting to the prime. Okay, so again, if someone asked earlier about managing your subs, again, that's a very important responsibility. Incorporating your subs expenditures in the prime's financial statements.
And any questions? Nothing new I've seen come in yet, but please enter your questions in the Q&A section or the chat box. And any inputs from Walter, Adrian, Chris on the section above.
No additional comment.
Sorry, go ahead.
No additional comments from me, Chris. Yep.
Okay, let me jump to a couple questions that have come in. So one is SF 425 filled monthly or quarterly?
Well, it depends on what your award, I believe, of what your award says, how often you have to report. So it's certainly, it's
similarly,
a
what is
format.
Generally,
Go ahead.
just a similar related question? What is the time frame for submitting financial monthly reports?
I will defer to the AOs on the call.
yeah, so Chris here, just to kind of shed a little bit more light on that. So depending on the program, they may require or ask, the AOR may ask that you provide financial monthly reports that are broken out even more than what the SF425 does allow for, because of the abilities that the SF425 is very straightforward, high level, doesn't capture some specific nuances. So hence the need for a financial monthly report. But the SF425 is done quarterly. I'll have to double check to be certain in CFR, but it says under extenuating circumstances, you usually just ask for quarterly SF425. So it's it depends type of answer, but normally, typically, SF425 is quarterly. and the AUR may request additional, more in-depth information on a monthly basis.
This is Adrian, just dovetailing off of what Chris said. He's absolutely right. The SF425 is traditionally quarterly, and to answer the question, it's generally due 30 days after the end of the quarter, so that you have enough time to figure out what you spent in that last week, right? If we did it at the day the quarter ended, you might have a hard time capturing all of the costs that you just spent yesterday. So it's generally due about 30 days after the end of the quarter. But this, as Doug said, check your award. Your award will specify exactly when you should be submitting it.
Great, thanks for that clarification. Another question for fixed term contracts, do one report in these do they do one report in these templates, or is it just invoice based reporting based on the accomplished milestones?
Okay, I think they're referring to a fixed amount award. Is that, it's a fixed term
This
contract. I mean, that's
award. Yeah, go ahead.
a fixed term contract. So if, and I'm assuming this is under maybe a cooperative agreement, that's just an expenditure. I mean, so as as an auditor, I would say, did you get what you paid for? You said an expenditure for a contract. So if you bought, again, 100 cots, then you get 100 cots, that's just going to be an expenditure. I'm not sure if I understand the question accurately, so I'll leave my answer at that. But if it's an expenditure under a contract or some sort of procurement, it's literally just going to be one of these disbursements here.
Okay. Andrew, if you want to clarify the question, please do it as we'll move to the next ones, but if you want to clarify the question at all. And we have, can you clarify how you would bring your sub-grant financial into the prime financial report?
Yeah, so on the prime's fund accountability statement or income statement, okay, that's called, the USAID calls it a FAS, fund accountability statement. The prime will have a line item for subrecipients. Let me just zip back up there because I think here we do have one, okay? So great, we have, here it's under contractual, but that would normally be sub-awards, okay? Here it's contractual, it could be sub-awards. Okay, so yeah, under there, the prime will have to incorporate into their year one financial statements how much the sub actually, how much the prime dispersed to the sub. Okay, so when the sub sends money outside, or when the prime gives the sub money, that's an expenditure at the prime level. Okay, so I mean, one could go on to say that the prime is monitoring the sub, but they're not looking to see how much of that money the sub has spent. What is on the prime's financial statement is how much they've given the sub. It's an expenditure to the prime. It's going to be income or receipt for the sub. Now, it gets into accounting here. I think that might get beyond this course, but happy to put a Q&A together and we'll do that much more in detail.
Great, thanks, Doug. Is there compulsory supporting documents or reports to SF425?
Chris here. Looking at 2 CFR 200.327, there are no compulsory additional supporting documents, but again, in effectively managing the agreement and as well as the financials, your AOR may ask to see additional details that may not be clear. But again, just referencing the 2 CFR 200.327, there isn't anything compulsory that's required, but again, it's a case-by-case basis where there could be a request made of you to submit additional information.
Yeah, so I just want to further what Chris is saying. I mean, recipients, you should assume that all of this is going to be audited. Certainly, if you're over the $750,000 threshold, you might be sending this into USAID, but that certification right there says, I certify that these are real costs, okay? These are real disbursements. So you are certifying these are good costs and effectively auditable. So be ready for it. Now, every mission, certainly the OFM guys or the controller's office doesn't always have the time to every month or every quarter review this, but assume it will be and be prepared.
Great. No more questions I see at this point, so please, Doug, take it over.
Okay, well, we're at the last sort of discussion point, and this is about your pipeline and your burn rate. And the whole concept here is that there's some definitions of this, and this pipeline analysis goes back to the example we had earlier of our here, I believe. But the whole point is of a pipeline, you want to make sure in your burn rate that you have enough fun. And I'm happy for Chris or Adrienne or Walter to jump in. But the concept is that you need to know, are we spending our money too quickly or not fast enough? And I say not fast enough, meaning you're possibly not achieving your objectives. And so this is a long-winded, all these slides are just basically a way of saying, I've got so much obligated to date. It's a calculation. I've got my obligation. I've incurred so much to date. I've got so much left over. I've got commitments made that I'm going to spend money on. So my quote unquote, my total spend or expenditure is so much. I've got some money left over. I'm asking for funds for the next period. And then, I'm spending money. I'm not burning money, but I'm spending money. Okay. And the whole point of this is to say, my burn rate, is it fast or slow? And one of the earlier people who asked, can I spend more money on salaries? Well, for 1 month, yes. And you might, as Adrienne said, you might underspend month 2 and over 3 and under 4. But in general, you should be spending as per your budget. But if you've got everyone working overtime and you've got extra people on the project you weren't planning on, you're going to be burning too fast. And this sort of analysis would show you that. You're saying, guys, you have issues. You need to be aware you might be spending too much. And other than that, that's what this that's what this pipeline. And so the ADSs, I just want to say, you can get more guidance on this. ADS is on the USAID website, Automated Directive System Series. So you could literally, there's a beautiful search engine in the USAID site. Just type in ADS 602 and you can get more guidance on this. Okay. But basically the concept is that you need to, that one of the reasons for being aware of this whole monthly financial reporting is to see how we're doing. Same sort of thing here, right? I've got so much money approved. I've spent so much to date. I've got so much total expenditure. Here's the remaining amount. Is this remaining amount going to be enough to get me to the end of my project? That's what that analysis will show you. And you want to do that. And if you don't, if it's not, talk to your AOR, and certainly your AOR, you'll explain why you're overspending or underspending. I think you worry if you're you certainly worry if you're overspending because you can't spend more than your obligated amount. Be careful there. But, if you're achieving great things, who knows? Possibly the mission may say, well, great, you're picking up someone else's slack. They may be able to obligate you more funds. But certainly you don't want to run out of money and then start to wake up and say, dear, AOR, we're done. We don't have any more. That's too late.
And just one point, this is Debbie, on pipeline, and it may be a conversation or an additional webinar we could focus in on, but PEPFAR also really closely monitors this and has some strict guidance on how many months of pipeline are supported. So I don't know, Chris or Adrienne, if you want to chime in on any of it, or maybe it's just a topic for another conversation.
Chris here. Yeah, the pipeline and burn rates, so depending on the program, specifically PEPFAR versus everything else non-PEPFAR, the rules may change based on the amount of allowable pipeline, but in any case, it's likely going to be a whole nother session, if you will, on pipeline and burn rates, because we can get into so many different nuances between USAID regs that are imposed by OGAC and implementing PEPFAR programs. So that's just an internal process of ADS, which may be different based on CDC or other agencies as well.
And we can follow up in the notes with some details and maybe a focused conversation on it at another point.
Yeah, I think I agree with Chris 100%. I mean, USA could be different from CDC, but PEPFAR is very specific. So again, read your award, work with the mission, work with the AOR, be compliant. Okay, well, guys, that was all we had. So I think we still have about 10 minutes at least for general Q&A or any comments. So I'll I relinquish my time, as I said in the impeachment hearings, to Callie and everyone else.
So thank you all, Doug. That was great. And we really appreciate also the questions that came in. It's really helpful to hear your particular questions for us. So please continue to send them in. I think there's one more that's come in right now. Is it okay to allocate salaries and travels related to personnel doing activities to other direct costs?
Okay, so you got to be careful there. Anyone who charges the salary line item, let's just jump back up to here. Anyone who's going to charge salaries under a budget has to do timesheets. Okay, let's just be very careful. We're talking personnel on this line item. You have to justify those costs with monthly timesheets properly. As per your policy or the U.S. government policy on timekeeping, it's 431 personnel costs documented. Now, I don't want to get too deep, but other direct costs, you might charge certain types of activities down here for your finance, HR, procurement, IT, people who might be considered indirect people as ODCs. To do that, you have to have proper allocation methodologies to be able to show why this project picking up its fair share only of HR, IT, finance. So we call it it's an iteration process where if you want to do that, I want to know, as an auditor, I want to know what the finance people did all month and only make sure that this specific project picks up its fair share of the finance team, okay? And that's it's a process one has to go through to allocate. So like when we talk about allocability, it would be this allowable process here. It would be like this allocability here. Show me that how HR, finance, or whatever benefited this project. And so generally, we could do certainly a whole webinar on this one, but this is where you turn what might be deemed indirect costs into other direct costs, allocated fairly to the USAID project. It is possible, it's just more work.
Thanks, Doug. So I don't see any other questions. And I do know many people have asked repeatedly throughout the session if we can share the slides and the questions and answers. And again, of course, we plan to share the slides out in the recording and then make sure we write up and have complete written answers for all the questions that have come in. And if you have any additional questions as you're thinking about the webinar, please send them. You have Catherine Brokenshire-Scott's email address who sent out the invitation, so please send them to her. She'll help bring those all together and be included in our Q&As that go out afterwards. But really, really appreciate, thank you so much, Doug, for your really thorough and clear presentation. And again, to all the participants, we really also appreciate having your engagement and your questions come in. And thanks to our USAID CFO and OAA colleagues in headquarters and those who are listening in the field too for your participation, because your input is also very, very critical in how we do this. So I think with that, Catherine, are you able to chime in and have any closing comments? I think Catherine was having some communication issues, so maybe she is still struggling. But with that, we'll close 1 minute early, and thank you all so much for your participation and presentations.
Thank you.